the prime lending rate, a long-standing reference point for banks when lending to top-tier borrowers. Currently, the prime rate sits well above the repo rate, guiding credit pricing for businesses and industries with high credit worthiness. The South African Reserve Bank said the move would modernize the financial system and better align lending benchmarks with current market conditions. And joining me to unpack this is Clive Ramathibela-Smith. That's a senior executive partner, Hecare Capital Partners. Thank you so much for joining me today.
It's a pleasure. Thank you very much.
Right, maybe South Africa is different, I hope not, but here in Nigeria, the prime lending rate guides lending to top industries and also supports priority sectors. I do not think anyone in Nigeria would want that scrapped anyway, but why is South Africa considering scrapping this benchmark?
Well, I don't think that's a very fair analysis, but nonetheless, I respect my my Nigerian counterparts. There's a historical background to things that have been changing alongside with financial models in South Africa, given our history, the history of the bank itself, the Reserve Bank, the inception of the rand as a currency, moving from the pound, and concentrating mostly in a country like South Africa that is really strong in terms of mining and resources. And so therefore there had been argument about how do you control the levers of currency exchange when you also have a complicated interest rate which has got a shortfall of about 3.5% to its prime. So what is the history? The history is, my sister, unfortunately, banks have used this to their advantage. So what the Reserve Bank has been doing is borrowing our bankers money at a cheaper rate than what they give out to the rest of the public or private sector. What that means is that that shortfall does mean that we, as a consumer, pay far more in rates than what the banks themselves are borrowing the money from the Reserve Bank from, or they're printing money from the bank. So the problem here is that very core structure of that 3.5% deficit that's created, unfortunately, unfair competitiveness that's created by that lag. And unfortunately, when as economics you do the numbers, it seems very unfair, particularly in an environment where you have high inflation, which creates a situation where the bank's regulatory framework says that they must keep inflation at a targeted range between 3 and 6%. So if it goes outside those levers, that means that to the benefit of the consumer, or the worst of the consumer experiences, because obviously then the private sector, the banks themselves have a better control of how monetary policy is supposed to work, as opposed to how it affects business and the private sector.
Well, we're looking at a 3.5% addition. So what for you would be a fair rate, considering the repo rate, which is expected to be the standard in South Africa?
You know, the difficulty here is because it's a new environment for us, even as people who are practicing in the financial services sector. You know, around the world, you mentioned, for example, our brothers there in Nigeria, what they've been doing. But if you look at global standards, global practice, you look at the US federal government or Federal Reserve, you look at Bank of England in the UK. The standard practice is that there's not much of a lag as wide as 3.5%. And by the way, you have to obviously be able to consider what consumer activity is going to be in that particular framework, because obviously the cost of living, the cost of borrowing money from the bank is excessively high. And so in order to control both the inflationary measure of that, controlling both on the bonds as well, you need to make sure that it's more in line with the repo rate so that it does not go outside the scope. What that does, my sister, unfortunately, whether the banks are doing it for the right or wrong reasons, it gives them unfair advantage over the consumer spending. And that is what we are crying out loud for. And we are hoping that they will do it in a more regulatory framework, so it's much closer to one another than the current 350 basis points, as you've rightfully conveyed.
All right, we're going to a very quick time out, and when we come back, we'll continue with this conversation. Please stay with me, Clive. Glad to know you're still with us, and we are still talking about the SARB scrapping the prime lending rate. Clive is right here with me. Thank you so much, Clive, for staying with me. I'm not sure you can hear me, but what would be the...
Okay, it's a pleasure. Thank you.
Great, fantastic. So talk to me, what would be the likely impact of eliminating the prime lending rate on businesses and the broader economy? And apart from that, I also want to look at if there are alternative benchmarks or tools that banks and regulators might adopt in the absence of the prime lending rate.
It's a very narrow road to walk, because obviously any change in that means that you need to take into consideration already existing debt by both the consumer and the private sector themselves. Then you also have to consider how that would impact on historical basis. Does that mean that if it is readjusted, that the debt at which you were charged at prime when you borrowed your car from the bank, or when you bought your car, when you bought your property, when you took your credit card, how does that then become aligned with the new reality once the adjustment is made? Who's going to pay back? Is it just going to be taken in future turns, meaning that you'll be discounted on your future debt? Or is it going to happen immediately? What about the previous people that have finalized their debt? Will they not have a right to ask the bank and say, listen, I've paid, and I've paid in full my house, my property, I've paid in full my vehicle. Now with this adjustment, that means that there's a potential rig, and that means that there might be a shortfall that I'm entitled to as a consumer. So it is very, very, very difficult. But nonetheless, the idea is to make it more aligned. As you said, like Nigeria, like we've seen in the UK and Europe, all those countries have become accustomed to how the structure works, because it's more aligned with economic activity, it's more aligned with the bank's mandate and how much it prints money, it's more aligned with the bond market and how that responds to the rest of the market. So banks may adjust based on those alignment to make sure that it links with the repo rate. But South Africa has got this issue with the fixed number, which is 3.5%. And to fix that, it's going to be a very difficult job.
Well, you've called it a very difficult job, and I was just going to ask you how important it is to approach the unwinding of the prime rate, cautiously. And we're talking 2027 here. Is that a realistic time frame for its implementation? We end with that.
I mean, our Reserve Bank governor says that it's possible. We trust him. He's just been given a new mandate. He's been extended, so people trust him. The committee he leads is also very trustworthy. Just remember that South Africa, in terms of regulations, we've just come out of some serious financial regulatory framework. So we've done that. We've done the 28 things that we're supposed to do to get ourselves back on the financial landscape and the grade that we deserve. So they wouldn't do anything, I am certain, that would jeopardize the recent financial regulatory framework that we've had to go through. And I believe that if it's done precisely as it's been recommended, and with the kind of financial systems that we've just introduced the twin tower approach, or what they call the two-pot system in the retirement framework that has been successful, the restructuring and reformation of the financial services sector itself under the Financial Conduct and Authority. That has been done successfully. So there's belief that it can be done successfully. The question is, will it land well with the consumers? And I think that's going to be a harder convincing to make than just doing the actual practical technicalities of getting us into a more aligned repo rate.
Right. Thank you so much, Clive Ramathibela-Smith, Senior Executive Partner, Hecare Capital Partners. I hope we'll have this conversation some other time. Thank you.
It's an absolute pleasure. Have a lovely day.
You too.